It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast. Yes, breaking down the Australian property market for you. Lots going on, isn't there? Anything can happen in this real estate cycle, as it's proven to be. And are you waking up in the morning and turning on CNN to just see what is playing out overnight internationally? If you're not doing that, I'm doing it for you, so we'll keep you updated. Trump has certainly fallen out of favour with many of his supporters, including Joe Rogan, who is now constantly criticising him. The worm has turned. It took Joe Rogan a long time to realise that. What do you think in terms of what all of this means and what is going on around the oil crisis and the economy? You can let us know with your voice message in the show notes. It's quick and easy to use, or you can email us anytime at myrealestatepodcast@gmail.com. Well, it's a Tuesday, April the 28th, as we near the end of the month. Happy birthday if you're celebrating today. You're sharing it with Al Pacino, who is turning 86, and Renee Zellweger. She's turning 57. Now, the Australian property market in April is shaping up as a two-speed market. Apartment construction remains under pressure, with developers citing higher building costs and slower project approvals. Mortgage competition is also heating up once again, with lenders quietly discounting variable and fixed rates for strong borrowers. Buyers who negotiate are finding sharper deals than advertised. So don't be shy. Ask the question and ask the tough questions. Some cities are booming, others are pausing, and buyers are becoming far more selective. As we take you into Sydney this morning, we catch up with Anthony Landahl, our mortgage expert, who is back from Equilibria Finance. Yes, lenders, they are discounting variable and fixed rates for strong borrowers. A lot of people might be wondering, what makes a strong borrower these days?
Yeah, good morning, Craig. Great to be here after the Anzac Day long weekend. Yeah, we are seeing some good discounts being offered for variable rates, but as you say, it is very much around the character or the criteria of the borrower. What I mean by that is the providers will be looking at the loan amount, but probably as importantly, they'll be looking at the loan to value ratio. So what we're finding is the lower loan to value ratio, if it's 60 or 70% or 50%, we are getting some pretty good variable discounts on those, which is making it quite attractive and creating some opportunities for clients who might be with a provider where the rates on the variable loan are stuck on over 6. Fixed rates are pretty set and forget. There are a couple of interest rate rises away from the variables at the moment.
Now, we have spoken before about the ever-increasing speculation around changes to capital gains tax and negative gearing ahead of the federal budget. It's creating nervousness, especially with investors who some are in pause mode. They're just waiting to see what the outcome of this is going to be. Now, the argument is that reform could improve affordability, while critics warn that it may reduce rental supply and investor confidence. So let's talk through this on the basis that the changes proceed. And on that basis, how could property investors be affected? And what ripple effects might we see across the broader housing market?
Yeah, look, I think the biggest issue for property investors right now is probably not interest rates, it's these potential changes. And that has created a certain caution. Just to quickly recap, what the government's talking about bringing in the budget is decreasing the capital gains tax concession from 50% to either 33% or even 25%, an asset held for more than 12 months, and also potentially limiting negative gearing to just 2 investment properties. We got to remember 70% of investors are mum and dad investors building their wealth accumulation. Look, I think there's a couple of sleepers here. I'll give you a couple of examples of how this may impact the market. Rentvestors is a way for first-time buyers to get into the market, to buy an investment property with the idea that they will flip it or sell it within a couple of years and then buy a home, leverage themselves into a home. that could well impact the stock of rental properties. We're also seeing a lot of people with maybe 2 investments may cap their investment properties. So that may limit landlords growing a portfolio and creating more stock. Another risk is potentially that some of these costs, because obviously the 2 key things for the investors are capital growth and rental return, are passed on to renters. There may be some stock freed up, but I think we're going to see a flow-on effect to renters in an already incredibly difficult and unaffordable rental market.
Yeah, that's really interesting about the rentvestors. And as we mentioned last week, the March quarter is around that 9.9%. It's its strongest number since 2022. Yet beneath the headline numbers, Sydney and Melbourne are cooling, while Perth, Brisbane and Adelaide, they continue to outperform. Global uncertainty is creating an anxiety for all sorts of reasons. You know, it's affecting everyone and impacting on how people can move forward with confidence. And we know that real estate is all about how confident you might be feeling. So let's look at what is driving national growth right now. And is the momentum that we're currently seeing sustainable, do you think?
Yeah, it's counterintuitive, isn't it, really, that we're at 9.9% growth over the last 12 months. It very much is a 2-speed market at the moment. We're seeing the sub 1 million properties, or the properties below the 5% deposit scheme, are really, really having strong growth. It's up 6.7% over the last quarter compared to across other markets of 3.6%. So that sub 1 mil particularly is really strong with first home buyers and investors. The other thing is that there are some regions still going very, very strong. 12-month regional growth, that's outside the major capitals, was up 11.7%. That is sheerly driven based on affordability, no doubt about it, whereas the combined capitals are only up 9.3%. So we're seeing a lot of growth in the regionals. I think underpinning our growth is supply. We've got supply shortages in Perth, Adelaide. Every capital city has a chronic supply issue, number one. And number two is the other issue is these migration levels, and we cannot sustain the level of migration and actually physically build the number of houses we need to house existing residents, let alone new residents coming out to Australia. The underlying issues are really driving this, and then we have got a 2-speed market as well.
We are talking to Anthony Landahl this morning in Sydney. When we come back, going to ask the question, why is rental affordability getting worse? And this has really snuck up on us pretty quickly. We're going to have a look at the rate situation because next week the RBA is meeting once again.
We are more than just a real estate podcast. We cover a multitude of subjects, including property data, current buyer-seller sentiment, and the mood of the market. Follow each week all of the main talking points and know your property.
Now, if you're thinking about selling your property and going alone without using an agent, got 3 tips here for you to employ. Spend money on photography first. Poor photos will absolutely kill inquiries. Number 2 would be to use a solicitor early on so that contracts are ready immediately. You don't want to be chasing your tail in this area. And third, set inquiry response times under 10 minutes because speed always wins buyers. It's amazing how many people are very casual when it comes to inquiry response times if you are selling without an agent. It is a Real Estate Tuesday. Anthony is here with me talking all things real estate. Now, across Australia, rents remain under intense pressure as vacancy rates stay near historic lows and supply struggles to keep up. Now, population growth, limited construction and fewer available rentals are all adding to the strain. For tenants, affordability is deteriorating fast. So let's look at the deep-rooted cause creating this rental crisis and how long this could continue, Anthony.
Yeah, it's an interesting one, and it probably ties back a little bit to what we were talking about with some of the impact potentially on the investors, where we've got a shortage in stock. National rents are up 5.7% on the 12 months. You're essentially paying close to 6% more on your rent. 5 years of sustained rental growth has added $202 a week to Australians who are renting. Now, that's an incredibly significant number there. And rental affordability is an absolutely massive challenge. Households now commit 33% of their gross household income to rent. So there's just a couple of numbers that show the starkness of this situation. The big thing we're seeing is a drop in rental listings, essentially, again, coming down to supply. Our rental listings are 18% below the 5-year average, and the shortage is most acute in Sydney and Melbourne, where stock is in fact 27.4% and 21% below the long-term averages. So there's essentially not enough supply. That's driving up the price of rentals. We got vacancy rates nationally below 2%. In some states, they're as low as 1%. So again, the rental market is suffering from a shortage in supply, which is driven by those factors we talked about before, and potentially could have further impact coming down from the downstream effect of changes potentially to CGT and negative gearing.
Yeah, the rental market. Boy, that is just an ongoing problem. Now, talking of problems, rates and rates. Oh boy, this remains one of the biggest forces shaping property decisions this year. People are exhausted and fed up with this yo-yo effect and the uncertainty that it causes. It's tiring, and I understand how you feel with this one. It's like being on a bus with a drunken driver, wondering how we are all going to get out of this dangerous situation. Several major banks, they have shifted their forecast, with some expecting further tightening, while others see cuts later in the year if inflation eases. Is inflation, though, going to ease with this Iran oil conflict? Hard to see that happening. And let's not forget that the RBA has got another meeting coming up next Tuesday. Yes, that sort of snuck up on us, May the 5th. So, Anthony, what is your take on interest rates and what might happen for borrowers and buyers?
Yeah, look, I think it's almost a fait accompli that next week's RBA meeting that the cash rate will go up 25 basis points. It's currently at 4.10. That'll take to 4.35. Who knows? The RBA might even bring down a sledgehammer and go 50 basis points. It has been an interesting couple of weeks. A lot of the major banks now have reset their forecasts to 2 or even 3 rate rises over the course of this calendar year. And so there's more conversation around this inflation is entrenched. And yes, we got the short-term shock of the war in Iran flowing through, but I think as well underpinning it has been a lot of the out-of-control government spending that we've been seeing, the electricity rebates coming off, the surge in rental markets, those sort of things. So even domestically, inflation was becoming a concern again. And then with the overlay of what's going on overseas, some economists are now looking at 2 or maybe even 3 rate rises.
All right, we'll leave it there. That is Anthony Landahl with his opinions, as always, around property. And Anthony, we will talk again next Tuesday as you bring us the latest result from the RBA. Have a great Tuesday.
Thanks, and great to be here, and have a good week.
We dive deep into topics like buying, selling, investing, and maximising your property's value, from mortgage advice to the latest property data and trending numbers. Your real estate journey starts here.
We've developed a business called ArcSite, which focuses on centralising large apartment building information into a single source of truth and giving that information and access to that information right back to the owners of the building.
In practical terms, how can centralised building information actually lift the value of a property or a development?
We're becoming more sophisticated as people looking at where we're going to be living and how we're going to be spending our money on our properties. Centralised information 1000% reduces the overall cost of a building. If we can prove that we're reducing our risks on buildings by the way that that information is being managed and who's accessing it, we can then go to insurance companies and demonstrate that we're lowering our risk profiles, and buildings need to be rewarded for that.
We connect you to the best real estate information across Australia. The Real Estate Podcast.